We have Neal Bawa with me here today. You can learn what his team is up to and how they can help you by heading over to multifamilyu.com, which stands for university. So I really appreciate your time here today.
Well, thanks for having me on the show.
So we're going to be talking about trends and what you're seeing in the marketplaces right now, which should be an interesting conversation because we're definitely seeing with affordable housing and just the housing market in general.
Yeah. Yeah. And, when I presented at conferences, that's actually a very popular topic about market trends. Homes are so expensive that there's a natural tendency to think that home prices will come down or rents will come down. And it really helps to apply a data lens to that.
What type of trends and what are you seeing regarding the data trends?
So the first thing to note is that when we look at home prices in the United States, you can now almost look at it as a BC and AC timeframe, right? We were seeing affordability in the United States going downwards and home prices going upwards before COVID. And home prices were rising faster than inflation before COVID. But COVID just simply broke a bunch of things. It broke the housing economy. And I don't see enough articles about this because it's a political third rail for either party to really talk too much about housing. They get in trouble with that because they don't have a solution. What happened since COVID? The average mortgage in the United States has gone up by 116%. But the average salaries in the last 4.5 years have just gone up by 20%. So the average American salary has gone up 20, but the mortgage has gone up 116%. Now that 116% is a combination of two factors. Number one, home prices have gone up about 50% since COVID. So, in 4.5 years, we're up about 50% in home prices. And recently it's moderated a little bit, but it's not going backwards, right? So home prices are still going upwards, but they're not going up as fast as they were in the first 2 years after COVID. So that's one component. The second component is basically interest rates have dropped, right? So today, 30-year fixed is somewhere around 6.5 to 7, depending upon which week or which month you're talking about it. I refinanced my home at 1.75%. It's a 15-year fix, but at 1.75% during the lowest prices that we saw with COVID, right? And then so what happened is that because of those extraordinary, absurd rates, 1.75% just makes no sense at all. Because of those kinds of crazy, mad rates where lots of people refinance at 3%, home prices went completely ballistic in that 21, 22 timeframe. And since then, they've refused to come down. They should come down when interest rates double, when affordability is so low that it's lower than 2007. Last time we had a real estate crash, we are significantly lower in affordability of homes than it was at that point in time. And we still haven't seen any declines whatsoever. The bottom line is we haven't seen any decline in home prices. All that's happened is the rise in home prices has moderated. So they're going up slowly instead of going up fast. And as a result of that, you have the greatest single mismatch in US history between the average mortgage and the average rents. Now let's talk about how much average rents have risen by. 20%. Salaries are up 20% since COVID. Rents are up 20% since COVID. So rents are up exactly matching salaries, right? But the mortgages are just they're in a different class of their own. And as a result, we have this clear situation in the United States where the middle class, the new incoming middle class, right? Newer generations of folks. I'm not talking about Gen X. I'm not talking about baby boomers. Basically, their chances of home ownership today are roughly 1/10 of what they were in 2005. 1/10. I'm not saying there's zero, but let's say if there were 20 people that were becoming homeowners in 2005 out of this cohort or a similar cohort, then today in 2025, 20 years later, out of 20, instead of 20, there would be 2, right? So we are now renter nation for the middle class. If you are not earning a 3-figure salary, you simply cannot qualify to get a loan on a median home. And obviously there's places in the United States where that's not true. Places like Louisiana and West Virginia and markets that are extremely cheap. Detroit, suburbs of Detroit are extremely cheap. But if you sort of ignore the parts of the US that are not growing, that are shrinking, you pretty much need a 6-figure salary. But most of this new cohort that's coming in, the household incomes are in that 60 to 90K range. And so since COVID, we have marooned 18 million American families and banished them to the realm of forever renters. Their ability, and maybe a few percent of these will eventually get to the point where homeownership works for them. Because, some people get raises, they're progressing their career. But an overwhelming percentage of these 18 million families, the younger cohort, will never be homeowners. And I feel terrible about saying this, but it happens to be true, right? I'm not a politician. It's not my job to fix this. It's my job to simply follow the data. So when I'm looking at the numbers, they're not going to get there. The vast majority of them are not going to get there. So for the first time in American history, we will have a cohort that will basically have much, much lower homeownership rates than the previous generation before them. The United States homeownership rate is around 64, 65%. And the projected homeownership rate is in the 40s. What that means is that we are going to become more like Europe. Europe's very rich, right? So in certain markets in Europe are even richer than the US. But their homeownerships are nothing like the United States. The US was exceptional because we had a massive amount of land and a freeway system that allowed our cities to sprawl. The US hasn't built any major freeways in the last 40 years. Remember, if you go to Dallas, you see downtown Dallas, and then you see this circular set of freeways around it. In the 50s and 60s, places like that built a second circle, right? Well, we haven't even started on the third circle. It will take us another 2 or 3 decades to get to that point. So that land that was cheaply available for construction is gone. A lot of people are like, yes, but the United States, 95% of our land is just land. I mean, you get infinite amounts of land. That's a very nonsensical idea. I hear that all the time, and it's a very uninformed opinion. The United States is running out of land, which does not require massive investment of utilities to build. But we don't have that massive investment of utilities and transportation infrastructure. So what we are essentially doing and have been doing for decades, Jack, is that we are basically continuing to fill in the gaps where the roads are available, the sewage is available, the pipes are available, the water is available, and we're basically just filling in the gaps. And so each year, as we fill in more and more of that gap, we actually have less and less land available to build. And this is counterintuitive. And you might say, well, why don't they just go 1 mile further? Well, because for a parcel of land that is 200 homes, going 1 mile further means the developer has to put $10 million more in to drag the infrastructure there. This is not clear to people. They don't understand that in almost in any case, that does not work. The developer can't build homes that they can sell profitably if they're going to put in tens of millions of dollars into infrastructure. So every developer in the United States, the big guys like KB Homes and DR Horton, and the little guys like me are doing the same thing. We're basically looking for those infill parcels, and we're sucking up more and more and more of them as our population increases. There is this fundamental lack of understanding amongst American consumers that even though home prices are absurdly high, and I wish they would come down, they're not going to come down because the job of developers is becoming harder as time goes on, right? There's less and less of these parcels available. There's challenges that we're going to have to deal with in terms of zoned land in the next decade or two. Maybe we won't have to deal with it because our birth rate is slowing, right? So in the future, we may not need to build as many homes as we're building today. But for the moment, we are in a situation where being a landlord makes the most amount of sense that it ever has been, because solutions did exist to our problems that could have been implemented politically in 2005, 6, 7, maybe after the crash. No one's bothered to implement any of these solutions. And so the only solutions that we are seeing today are people building more apartments and then people building more starter homes and renting them out, right? Because you might say, why wouldn't people just buy those? Well, the number of people that can buy new homes is diminishing because new homes keep going up in value, and they keep on going up in value much faster than people's incomes are growing. So the percentage of America that can buy these brand new homes is diminishing. It's the percentage of new homes that are being bought by investors is increasing. Because as an investor, you can basically, make a 10-year forecast and say, okay, rents are going to increase at this point. I'll put this money in and probably won't make much money for the first 2 or 3 years. And eventually I'll start making money. And there's enough people doing that. So every year, a greater and greater percentage of homes in the United States are funded through investment because it makes sense. And so I don't see any scenario where we are going to see rent growth of lower than 3% in any year from now until about 2030. Last year, rent growth in the United States for multifamily was less than 1%. Some data even indicates it might have been negative. I think actually it was negative for the southeast of the country where there's massive amounts of supply. Single family was slightly better, like fractionally better, but it wasn't very impressive. But we've now gotten to the point where a massive amount of multifamily supply, which came in because in 2022, everybody and their mother built, including myself, right? Because money was free. So everyone built. It takes 2.5 years for an apartment to come online. It takes a year for it to get leased up. And so by the end of 2025, we'll get to the point where pretty much all of that massive, massive glut of apartments will be absorbed. And we'd be back to the normal level of apartments being built, the normal level of single families being built. And then we should see very substantial rent growth. 2027 is projected to be an incredible year for rent growth. I think we could easily hit 5% for the entire United States, which is a massive number. Usually we get 2% to 3%. And some markets could hit 6 or 7, like Kansas City is a market that doesn't have a lot of new construction, single family or multifamily. Indianapolis is another market. And we could see some massive numbers in those markets.
Yeah, you kind of answered what I was going to ask you was because, you were talking about the rent in the 20% versus a mortgage. Having any kind of leverage on these multifamilies, it's kind of topsy-turvy at the moment regarding the underlying debt and some of the services that we have to provide in these multifamily instances. That some, if you'd listen to the media, you'd think that the landlords are just making money hand over fist and rents are going through the roof.
Well, I think firstly, the media simply doesn't report the fact that rents in the US have only risen by about 1% in the last, I'd say about 3% over the last 2 years. Keep in mind, over that time frame, inflation was at 7%. And if you look at the 100-year line of rents in the United States versus inflation, they tend to be slightly higher than inflation. So if inflation is 2%, rents are 3, inflation is 3%, rents are 4. Last 2 years, the situation was reversed. Rents were going up 1% and inflation was at 3 or higher. Some part of in the last 2 years, inflation was at 5 or 6%. So rents have actually been negative on an inflation adjusted basis now for 24 months. And that's not clear. Never hear the media say it because then they don't get eyeballs. The media has to say things that make people angry to get eyeballs. And telling people, well, this weird situation has happened where rents on an inflation adjusted basis are basically zero is not going to get you a lot of, people clicking on your article. So I think what is happening is what you mentioned, Jack, which is right now is a very difficult time to price out multifamily properties because you've got to price it out, keeping low rent growth, over the last 2 years, and the fact that prices have gone down. So another thing that might come as a surprise to some of your single family viewers is single family is an emotional decision. It's a, emotional decision to purchase. And I understand that as an investor, you do your math. I get that. So it's not emotional, but the vast majority of the single family market is an emotional decision, right? People in the 1980s bought single family homes at 18% interest rates. We are terrified right now of buying as investors at 6.5%. People, millions of Americans bought homes at 18% interest rates in the 1980s. And then subsequently refinance, but they didn't know that when they bought these homes. The majority of the single family market is an emotional market. Multifamily is not like that because when you're buying a multifamily, you're buying a business and you evaluate the business based on its cash flow. When interest rates doubled in the last 2.5 years, it reduced the prices of multifamily. Didn't reduce them for single family, but it reduced it for multifamily. Depending upon the market, you've seen an 18 to 25% reduction in multifamily prices. But the cash flow has declined even more. So it's actually harder today to make multifamily numbers work than, let's say, any time before COVID, 2018, 2017, 2019. You actually had more cash flow than you do today, even though the prices are down. So it's actually extremely difficult today for anybody rationally to make multifamily underwriting work. And that's why transaction volume is down. prices are down. There's no distress. Why is there no distress? Very few people are selling. The only people selling are the people that have no choice but to sell. So, and that's a very small portion of the overall multifamily market, right? It's a bigger portion of what we call the syndicators market, which is this mid market that sort of emerged since 2013. 10,000 syndicators like me sort of tried to take over the market, and they initially succeeded, but then in the last couple of years that has been trending downwards. So that portion of the market is pretty distressed, but the overall multifamily market is not at all distressed because volumes are down. We are also seeing that in the single family market that, people ask this question, why aren't single family prices down if interest rates have doubled and mortgages have more than doubled? And the honest answer is not enough supply. That's the answer you hear most often. And it's somewhat true answer, not complete, but I think it's the biggest single factor. Same thing's keeping multifamily afloat, right? There's just not enough supply. Whoever doesn't need to sell is kicking the can down the road. The banks are doing a very good job of helping multifamily people kick the can down the road. Very few banks are saying, give me the property back. They're saying, put this much money in, I'll give you another year extension. And that's what banks are doing. So we're actually in a unique situation where it's very difficult to make multifamily work. But the forward-looking 5-year trends are extremely strong. One, because supply gluts, which have dominated in the last 2 years and probably will dominate for the rest of this year, will end. We know that will end because here's the cool thing, some crystal balls work better than others, Jack. One of the crystal balls that works very reliably is multifamily permits. A lot of single family people don't realize that multifamily permits and multifamily supply affects rent growth for single family. Very few single family people track multifamily permits and supply, which is a huge mistake because you're fundamentally part of one rental market. Single family sometimes is below class A, sometimes above class A, depending upon how nice your single family rental is, right? So it could be above class A, it could be below class A, but it's not separated. If you have every class A property in your metro offering 2 months off, your single family rents will fall 100% of the time. There's no choice. They will fall, right? Simply because now a significant portion of people that would have lived at your property are going to say, oh, look at this class A property. It's gorgeous. It's brand new. It's got, infinity pools and rooftop decks and dog parks. I'm going to go live there because they're offering 2 months of free rent, right? A lot cheaper than single family. So that sucks, people away from single family. And what we are seeing, what we're very consistently seeing in the data is that when that glut ends, you're going to see a lot of multifamily raise their prices, their rents. You're going to see them get rid of those 2 months of concession. Eventually they'll come down to 1 month of concession, then 2 weeks, and then eventually they'll be gone. In 2027, older properties are 1 month off, newer properties are 2 months off or 2 months free. And so we are going to be in this sort of weird situation where you will see a significant increase in values because today's values are artificially depressed. Let me tell you why. If you want to get a Fannie Mae, Freddie Mac long-term loan fixed debt, 5-year fixed, guess what Freddie Mac and Fannie Mae do? Let's say your rents are $2,000 per month per unit and you're giving 2 months off. They calculate your rents at $1,600. So the value of your property falls, even though everyone understands, including Fannie Mae and Freddie Mac, that this is temporary, that at some point in the next year or two, we will return to a normal level of concession, right? And that is not understood at all by folks, that when you're buying multifamily today, you're getting a really good deal because temporary concessions, which are going to end either this year or the beginning of next year, are actually driving the value of the multifamily. They're driving down the value. It's an artificially low value for the next year or 18 months. So when you purchase, you receive a benefit. And that's another reason why we are not seeing multifamily prices go down. In Q4 last year, multifamily prices went up on a per unit basis. They didn't go down. They were going down for 8 quarters before that. So down, 8 times, and then an upward blip because people started to realize, hey, this glut is going to end. And when it ends, I'm going to be sitting pretty because when I paid the price for the multifamily in late 2024, early 2025, I made it based on those concessions being here forever. But if you look at the history of the multifamily market for the last 50 years, these kinds of concessions are a rarity. You get them 2 years out of 20.
Well, there's sure a lot of information that you've been sharing here with us, Neal. I'm just going to direct everybody to your website again, multifamilyu.com. there's a lot to learn here and a lot of things to take advantage of. What should they do with all of this information you're sharing?
I'm not a fan of single family versus multifamily. I'm not somebody that says multifamily is better than single family. It's not. Current cycle, multifamily prices behaved more rational. They came down 20, 25%. You don't have to be very good at searching to find a multifamily that's 25% cheaper than it was in 2022. It's fairly easy to do that. But I don't believe that there's a single property in the United States where you can even get the same price that you got in 2022 because prices have gone up. So it's just about rational behavior. Right now, multifamily looks more attractive to me than single family. But there are many times and many cycles where single family looks more attractive. I still continue to buy multifamily during those times because I'm tied to scale, right? I'm looking to buy, 1,000 units a year. It's just this part of the cycle. I feel like you're going to get more value from multifamily. And remember, you don't have to buy 200 units like Neal Bawa. You can go out and buy 2 units or 4 units. A 4 unit multifamily is still a multifamily.
Yeah, in my part of the world, the 4 unit still uh, qualifies for first time home buyers and the like. So if somebody is just getting into it for the first time, great option.
I think so. 4 units is sort of a very unique place. So in the multifamily industry, we actually chose multifamily starting from 5 units because 5 units are financed through multifamily loans, which have, let's say, more challenges with them, including prepayment penalties. When you buy a 4 unit property, it is still a multifamily property. If you lose one tenant, you only lose 25% of your rent, but you're going to get single family loans. And one of the nicest things about single family loans is it's illegal to have a prepayment penalty. So that gives you an extraordinary amount of flexibility with a 4 unit that you don't have with a 5 unit. If you go out and get a 5 year loan and you want to get rid of that property the second year, massive multifamily, massive prepayment penalty. So I think 4 units actually is one of those sweet spots that people should look at.
So is there any particular strategies like you mentioned some of the numbers are going to be a little off right now, but is there something in particular that we should be looking for or how we're running our numbers to make sure that we're getting into a good deal?
So I think most people know the basics of underwriting, whether they are single family or multifamily. What I would tell you is that whatever weightages you assign to things like job growth and income growth, rent growth, right now is a time to assign a very high weightage to incoming supply. So let's say I'm underwriting properties and I'm underwriting a 50 unit property in different markets in the US. Normally, you look at that market's 5 year growth, its population growth, things like that. I would strongly suggest to you that what you really need to be doing is that you need to look at the incoming supply in that market and that sub market over the next 12 months and make that your focus. Make that your focus. So I would tell you is the best markets in the United States to invest in today are the markets that have the highest concessions today, but they have an abrupt drop off in supply in the coming 6 months. So once again, highest concession. So you can say parts of Austin, parts of Phoenix, 2.5 month concessions. But then these particular submarkets in a 5 mile radius have an abrupt drop off of new supply in the next 6 months. So you are getting the maximum benefit of the concessions driving down your purchase price, but you don't have to suffer for more than 6 months because when the supply drops off, the concessions will drop from 2.5 months to 2, 1.5, then 1, then 6, then, 2 weeks, then nothing by 2027. So you've timed it to the very best. That is, in my mind, the best technique today. The technique also worked for single family, except you would have to convince some broker that to give you that CoStar report. Remember, supply information is in reports called CoStar reports. CoStar is very expensive, but you can always get a CoStar report from a broker that you've befriended for a particular submarket. So when you're comparing submarkets, do not invest in submarkets that have a lot of incoming supply. In a CoStar report, supply is represented by blue lines on the page that basically shows forward-looking supply. You want to look at, let's say a market has 10 submarkets. All you have to do is pull the 10 reports from CoStar and look at the blue lines beyond the dotted line. The dotted line represents today. So on the right side of that, if you see those tall blue lines, That's bad.
Look for the short blue lines. Neal, this has just been fantastic. I really appreciate you giving us so much time here today. I'm going to direct everybody again, multifamilyu.com, multifamilyu.com. Before we close out this episode, is there anything we should have hit on?
Well, I'd like to just invite everybody to Multifamily University. Think of us as the Wikipedia of information related to single family and multifamily real estate. We have no education product. We don't have an upsell. Pay this and you'll get this value. Nothing like that. Everything that we've ever offered for 10 years on there is free. Last year, 10,000, 11,000 people signed up for our webinars. Most popular one is Real Estate Trends, where we analyze 100 markets in a single 75-minute session, give you our recommendations. We don't tell you where to buy, and we certainly don't tell you to buy them with us. We simply say, these, for these reasons, are the best markets in the United States to invest in. Have fun. We'll see you in a year. Check out multifamilyu.com.
Well, if you don't mind giving me a couple more minutes, we'll hit you up with some rapid fire questions and close out this episode.
For it.
What lie do real estate investors often tell themselves?
That the future will be like the present or the past. We no longer are in an environment where the future represents the past. So we have to be continuously adapting.
If you could go back in time and give your younger self a piece of advice, what would it be?
Thing called Bitcoin.
Right? I always joke that if I would have taken action when I first heard of Bitcoin, I would have been millionaire. But then I would have also lost my key, and then I'm sitting on a USB key that I couldn't access. Do you have a book recommendation, or what are you reading right now?
So my book recommendation always is The Miracle Morning. It may not be your favorite book, but if you follow it, you will have time to find your favorite book, because The Miracle Morning structures your day for maximum optimization, including reading other books. So it may be your conduit to your greatest book of all time. So check out The Miracle Morning.
And then finally, what single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
Data. So we tie everything back to data science. We basically believe that you can only manage what you can measure, and we apply that to everything. Sometimes that's a very brutal thing to say, but it's true. We also continuously behave based on this one principle. Data beats gut feel by a million miles, right? If you believe that, you'll fundamentally be better at your job, regardless of what it is that you're doing in life. Apply data to your personal life as well. I apply it to everything I do. It's a mindset.
Well, Neal, this has just been fantastic. One last time, Multifamily University. Make use of those resources and webinars and everything that they have going on there, multifamilyu.com. Those are going to be clickable links in the show notes. Really appreciate your time, and it was great meeting you.
Thanks for having me on the show.